Let me go to my slides, and I can send you these afterwards if you want to explore the links yourself, because what I'll do is tour the web whilst I give my talk, at least the first part. So there are 3 parts to the talk. The first is just in general about research and the data. Understanding the markets that you may be doing research in is to me, you know, really important. It may not be important to everyone. And then I'm just going to be talking about a couple of papers with the same PhD student who actually has his viva tomorrow, Michael Dakos, because these are about, spot markets, if you like, the cash markets rather than derivatives. I decided not to talk about derivatives because of the profile of the audience here, even though most of my research is on derivatives. So let me just give you a small introduction with this slide about the research articles. I simply, like yesterday, I put in crypto with a little asterisk, which means it could be cryptocurrency, crypto markets, or crypto anything, or Bitcoin, which is the most common one that people are writing about. And I put it in the Scopus search engine, just looking at economics, finance, and econometrics. If I'd included business and management, I would have had even more, but just looking in the fields of economics and finance, there were 3,000 articles, 74 are review articles, and just in the last couple of years, since 2020, there are 1,800 articles in Scopus. These are published ones in journals that subscribe to the Scopus service, and 42 review articles. So, I mean, it's really amazing the number of papers. I already showed you the SSRN site, how many papers there are there, thousands already. And then I started looking at the journals. I'll return to this a bit later, the journals that are publishing in these areas. So the top journal by far is Finance Research Letters. That's FRL, as you can see here, FRL. So 260 articles, of which more than 200 since 2020. The next one is Research in International Business and Finance, which is, I think Finance Research Letters might be what we call a three rank journal in the UK, but this one is definitely a 2 rank. The top is 4-star. And International Review of Financial Analysis, that's a rank 3. And then there's something called Financial Innovation. I don't think that could be more than a 2. Applied Economics Letters and Economics Letters. And they haven't had nearly so many. But when you see the number of articles here, for a small journal, 60 articles on and something to do with crypto or Bitcoin, and that was just a very rudimentary search, shows that these journals are really specializing in those topics. And on the right here, you can see impact factor, IF. You can have a 1 year, 2 year, 3 year, you know, it's an average if it's over more than 1 year. And it's to do with the citations. That's how these impact factors are calculated. And in 2017, before they started, the craze to publishing crypto really took off. Finance Research Letter had a very low impact factor of 1.08, so probably it was a 2-star at that point. Research in International Business and Finance didn't even have one. IRFA, International Review of Financial Analysis, has 1.5. And let's set that against the top 3. These are the 4-star journals: Journal of Finance, Review of Financial Studies, and Journal of Financial Economics. And they all had 5.4 or 4.27, 5.2. And, you know, the impact factors have gone up in those journals, 7.9, 8.41 for RFS. So it's just number 2 above Journal of Financial Economics, which is 8.40. But these other journals, I mean, look, this Research in International Business and Finance now has an impact factor of 6. Finance Research Letters has an impact factor of 9.85. And, you know, these are directly correlated to the number of articles that they are publishing in on crypto or Bitcoin. I mean, I don't quite know what to make of this. I really don't. I mean, once the craze for publishing in crypto and Bitcoin is sort of over and more mainstream journals start take, because a lot of them wouldn't take articles. I remember writing in 2018 and I sent an article just to the Journal of Portfolio Management because it was a very applied practitioner sort of article. And they said, oh, we don't take any. We won't take any articles on crypto at that point. So I sent it to the Journal of Alternative Investments. Anyway, so the point is that you can publish in these low, well, high ranked, but used to be low ranked, certainly journals that are not held in high regard by the majority of the academic community, if your university allows you to. But when you look at those papers, there is virtually no understanding in most of them about what they're actually doing research on. I'll return to that later, actually, right at the end of this talk, and we'll maybe have time for a little bit of a discussion about that if I don't go over the hour. I think I have. Anyway, so I thought I would start with quite a few slides. I mean, I can talk about my own papers, but I want to talk more about understanding the markets and the data. You see, that's the thing. Data is so easily available on these markets. So, I mean, this is Crypto Compare. It's one of the many, many data providers. Here you can see the top 10 ranked coins. These are the stable coins, perhaps not quite so stable. There's 3 of them: Tether, Binance, USD, and USDC. And they are ranked in terms of volume traded. And so obviously Bitcoin and Ether, I don't know what they call it, Ethereum. Ethereum is the blockchain. Ether is the currency. And then there's Ripple, Solana, AVAX, Binance Coin, Cosmos. Okay, so, and they rate them like this. Then the 3 original ones, Litecoin's still up there with Ripple. Let's have a look at the website. There's quite a lot that you can get from this website, actually. I particularly like their research. So if you look at their reports and research here, you get a lot of overview. You know, the exchange review, for example, you can just download here, will give you a fabulous summary of what's happening in centralized exchanges. But this is it's what we call the CFI data. There's another one called Coin Metrics, and Kaiko, and Coin Market Cap. There are plenty of these. They used to be what we call ranking sites, but now they've just gone into sort of data provision and research. Okay, so you have to distinguish between what we call traditional finance, TradFi, CFI, centralized finance, and that is these exchanges that are actually off the blockchain. I liken blockchains to like multi-way motorways or expressways, freeways, whatever you call them, with these off, you know, like the NFT marketplaces or these exchanges like Binance, Huobi, etc., etc. These are off the blockchain, and a lot of them won't accept fiat. But for example, Binance is a crypto only. You have to, well, you can use Binance as a broker, so you can put fiat onto Binance and exchange it for Tether, which you then use to trade. The Tether is the sort of main, or Binance Coin is now taken over, I think. But you can't take fiat off. Anyway, so what you do on Binance or some of these other exchanges which do accept fiat, like Kraken or Coinbase, for example, that's not recorded on the blockchain. The only thing that is recorded is when the exchange has like a hot wallet that you put crypto onto the exchange and take crypto off the exchange. That will be recorded on blockchains, depending on the blockchain you use, of course. And the good thing about blockchains, of course, everything's recorded. if you run a full node, then you can get the entire history of all the transactions on the blockchain. So it's quite transparent in that respect, but you can really obscure the trading you do by just loading fiat on and off. And it's very difficult for regulatory authorities to keep track of this sort of thing. Anyway, and then you have the decentralized exchanges like Uniswap. Here you can see the market cap of the Uniswap tokens. So this is from into the block. There's a lot of data on into the block, not to be confused with the block, which also gets data from so this is the Curve pool, for example. So the trading on decentralized exchanges like Curve and Uniswap is swapping one currency for another, and they don't use the same sort of order book mechanism with a market maker and limit orders and bid and ask prices and that sort of thing. It's all to do with liquidity. That's what's called an automated market maker will give you the price here, where the more liquidity that you have in the pool, the lower the price will be. If you take a lot of liquidity out of the pool, that will increase the price. So there's an awful lot to learn. That's the message, really, is that if you're going to go into this area, then you really need to go into the markets and understand what's happening. There's quite a few papers coming out now on NFTs, non-fungible tokens, in particular what we call PFPs, the profile picture ones, or generative avatar, as opposed to generative art. I mean, NFTs come in all sorts. There's land NFTs in the metaverse or augmented reality. I've bought Brighton Pier, the London School of Economics, and the business school at Sussex University. Only cost me a few dollars each, but you never know. In a few years' time, somebody might need that land in the pier because they want to advertise McDonald's hamburgers or something. So that was quite interesting. So I always somebody needs to mute themselves. Okay, I always buy a little bit of whatever it is I'm teaching, because I teach a couple of modules at Sussex on crypto and blockchains. So OpenSea is the biggest marketplace here, and most important collection is the Bored Apes, or the apes in general. You know, the Bored Apes are the first ones, but you know, this is called a yacht club. This talk is not going to go into that because I've just started getting into NFTs in a big way, but I'm far too early to give any talks about them. But anyway, if you want to get data on NFTs and have a look around, I would recommend Nansen for the analytics and the data provision. So that's where I got this graph from. And NFT God mode will, for example, you can look at, I don't know, let's have a look at aliens. There are thousands of these collections. It'll give you all the data on collections you can download and analyze price rarity relationships, or this sort of thing. Okay, there's just data everywhere. That's the problem with crypto. That's why so many people are drawn to do a bit of research. They get some, oh, here's some new data, let's put an old model on it. Not my idea of the best type of research. Okay, so what else have we got? So the block, I already showed you into the block. Now this is the block, they're different, okay? They have all sorts of data on spot markets, futures markets. They also have NFT data. The Chicago Mercantile Exchange is the only fully regulated exchange that actually trades Bitcoin and Ether options, and so you can look at spot, you can look at futures, you can look at options markets. The main one there is Deribit. You can see this blue is the volume on Deribit. The share of open interest is just going up all the time. That's deribit. Ether options, again, they're calling them Ethereum, which really annoys me. Really, because we're ahead of an event called the merge. So options are a very good way of betting on what's going to be the outcome in September of this merge of the old proof of work chain for Ethereum to the new proof of stake. This chain has been running for a while. A lot of Ether is locked up with the staking on this beacon chain. Anyway, going off topic, just talking about the data. So in the spot markets, you can see that if we just look at the year or last 12 months, here you can see that volume's been going down quite a lot since November 2021. That was where the peak in prices and also the peak in volume. We've entered something called a sort of crypto winter. Something happened in May with a collapse of a new type of stable coin, not the sort of collateralized stable coins, Terra USD, Binance USD. Those are the ones I showed you. Those are what we call collateralized or custodial stable coins. They're supposed to have, for every $1 billion they issue, and there's about 140 billion issued with those three together. They're supposed to have fiat currency or equivalents, or very short-term things like treasury bills, supposed to be collateralized. And then there was this new type. You might have heard of the Terra Luna collapse in May. It was a protocol attack on the liquidity curve pool. That's made the whole everything collapse. The volumes will come down. We're in what we call another crypto winter. But, we have been in crypto winters before now. This is from Crypto Compare going back to 2018. And although these may not look very large areas, some of them you can just choose your thing, but this was actually a boom and a bust. This was a boom and a bust, but you can't really see because the volumes just really started taking off in 2021. That's really when we have to, the new era started January 2021. So many papers are not using that data. We'll have a look later at some of my research that surveys other research. These crypto-only exchanges like Binance, as I said, they're not a fiat exchange, whereas you've got fiat exchanges, Coinbase, FTX, Kraken, and so on. But the market share of Binance is just going up and up and up. It's soon going to be about the only monopoly in spot. And on the futures, again, it's Binance that dominates with these things called perpetual stock swaps. These funding rates, understanding the new types of products, the leverage tokens, the perpetual swaps, this is what I've been focusing on, but I'm not going to be talking about that. But that's what I find very interesting about crypto research is that, you have the opportunity to explore new types of trading, liquidity pools, not order books, and new types of products, new types of commercial structures where, for example, these exchanges, the centralized exchanges operate as their own clearinghouse. There's no margin calls on the futures. They just liquidate you. And if you're unlucky, they'll make you bankrupt and liquidate all your positions. Yeah. Anyway, so enough said about that. Let's go back to these data. Here's an indication of the volatility. This is something I developed with Crypto Compare. It's just like the VIX index using options data. I did it with my student Arvin Imarai, who's working on options, on crypto options. And you can see that volatility, for example, in May went up to over 100%, but its base level of 60% is actually, you know what, that's really high for equity volatility or currency volatility is never up to 60%. And Bitcoin is the least volatile of these crypto assets. So we're talking about a hugely volatile, there's the index now, sort of real time. You can just see over the last day. It's updated every 15 seconds using the data from Deribit. Okay. So before I go on to talk about a couple of papers, let me just explain that the data you use really matters. So you can get data directly from the exchange, but the point is that Bitcoin is traded on so many different exchanges, or any other coin probably. Most coins are not traded on just one exchange. So you have to either get exchange data, which is different. There is obviously cross-exchange arbitrages will keep the prices pretty close, but not exactly the same. And so what you see if you go to Crypto Compare or CoinMarketCap, CoinGecko, Kaiko, Coinmetrics, etc., will be an index, not a traded price. So be careful of that. It's fine if you want to look at things like risk metrics or so forth. But if you're actually looking at a trading strategy, these are not tradable prices. They're a volume weighted, what we call a VWAP average. And some of them use lots of sources, which is ridiculous. For example, CoinGecko, Kaiko, CoinMarketCap, they use more than 100 different sources, which is because they infer prices and volumes in particular from cross rates. So if they haven't got, for example, a Ripple euro on an exchange, what they'll do is they'll look at a Ripple Bitcoin, which may be traded, or a Ripple Tether, which is probably traded, and then a Tether euro rate. But you can't get the right volumes from those. It's impossible. So I much prefer Crypto Compare or Coinmetrics. Probably Coinmetrics is the best data, and they're pretty good at that, giving it for academic research purposes. Then if you want a broad market index, the usual cap-weighted index is, well, I showed you on the first slide, didn't I? The cap of Bitcoin is just so much more than, okay, market cap, 390 billion. Ether is coming up there now. It's 200, and I would say within a year, they're going to be about equal. Bitcoin's already rated B+ and Ether A-. And so these are equalizing. We wouldn't count these, of course. These are Tether and Ripple. Well, we'll have to see what's happening with the regulators in that case. But you see, if you do a cap-weighted index, it's almost all Bitcoin and a bit of Ether. So these standard indices that you get are not really representative. You can get equally weighted indices, but of course they're not. It's very difficult to trade an equally weighted index. Well, it's difficult to trade a cap-weighted index as well, but that's the sort of standard for S&P 500 and so forth. So you've got the Bletchley, the MVIS indices. You've got something called the CCI 30, which I rather like because it uses the square root of market cap, so it sort of reduces the dominance of Bitcoin. Anyway, so there's a lot to be done on these market indices still. They're far from perfect. Okay, so where am I? What's the time? Okay, so let's have a look at one of the papers that I've been writing on what we call token offerings. So there are two types of cryptocurrency. There's the native tokens of the blockchains. So Bitcoin, Ether, Ripple's slightly different actually. I won't talk about that, but Aave, all these native tokens that have their own blockchain. These are the tokens that are created when you build a blockchain. So each block has a certain reward. And also they're the tokens that Ethereum and other smart contract blockchains are used to power smart contracts. So a smart contract, oh, everything's a smart contract, will be in the digital economy, everything will become a smart contract on a blockchain, which is why the Ethereum chain and others like it is so important. So with those coins, those native tokens, they have a real utility. So for example, in Ethereum, what we call gas is how you measure a smart contract. Is a self-executing code. For example, you know, JP Morgan may be using Ethereum or its own version of Ethereum for doing interest rate swaps. So you do without the back office people that have to do accounting for these swaps. It's all recorded on a blockchain, and the good thing is that it can't be changed. The whole point of blockchains are their consensus. These public blockchains have a consensus algorithm, which means that they can't be changed. They are immutable. So it's very secure in that sense. So as I said, everything's a smart contract. But when you put a smart contract, it's code. So, you know, it's got binary operations with adding and subtracting and things like that. And each one of those operations has a certain amount of gas associated with it. You've got a sort of iterative loop that has a certain amount of gas. And gas is measured in a tiny unit of ether called a gwei, gigawei. Just like a little unit of Bitcoin is a Satoshi, we've got these little gigawei, right? And so that distinguishes, distinguishes native tokens from all the other sorts of tokens. And NFTs are their own smart contracts. That's a whole sort of different things. But the DeFi tokens, that was the craze in 2017. NFTs sort of started here in 2019, 2020. But the DeFi token craze, and these are crowdfunding tokens. There's no blockchain associated with them. And you can see that the number of what they used to be called initial coin offerings, ICOs, 200 per month, okay, or 250 per month. How much was raised? You know, $1 billion was raised in March 2018, and so forth and so forth. And then they fell off with, this was another crypto winter caused by just manipulation of Bitcoin. That's the usual thing that creates, you know, the big players are just manipulating Bitcoin, or they're getting a little bit more sophisticated. The May crash was caused by, you know, the big Wall Street gorillas manipulating the Terra Luna stablecoin by taking a big short on Luna. But mostly it's just, if you look at my blogs on my website, you'll see what I talk about, the Bitcoin Tether Ponzi scheme, right? Anyway, so they went down. Then we had the pandemic, nothing much happened. And this paper has been a long time in the process. We started it around here, and now we'll be updating it because the token offerings have taken off again. So I haven't issued the paper yet. So just doing a proper scope of search, not a little baby one that I showed you. So there are 102 papers since 2020, 171 papers in total on initial coin offerings, or ICO, or token offering, or also called initial exchange offering, IEO, security token offering, and so forth. Okay, in fact, there's now also what we call the IDOs. And when we look at this, the different journals, Small Business Economics is the most published, as most of these papers. Journal of Corporate Finance also has a lot of papers in this area. But when I look at more detail, these are papers published in 2022, 2021. We've just looked at those that are looking at the same sort of problem as we are, the determinants of success of an initial coin offering, or initial DEX offering, initial exchange offering, okay, or ICO, as they used to be called. The data are very old. I mean, ends in the middle of 2018. This one, although it was published in 2022, the data end in 2018. And the number, this one has the most, this paper here, Thais et al. It had 1,600, but still not very many. And what did this one find? It just found that the rating was the only important positive determinant of success. And the R squared was 0.11. I mean, the R squareds are pretty low here, aren't they? Some of them do find rating, team size, whether or not there's code on GitHub for the project, because don't forget, these are trying to raise money for a DeFi project, something related to blockchain and coding. And so, you know, if they've got a white paper, that doesn't seem to matter very much. I recently looked at whether getting a patent matters. And in fact, patent specialists were saying, no, you know, in fact, it's probably a negative determinant of success if you want to raise funds. Anyway, so all these different variables, the price that they set during the pre-sale, the supply of them, these are done separately, but usually, you know, these are very highly correlated. So it's not much point in putting them together, because you can either supply a lot of tokens with a small price or a few tokens with a high price. So we look at market cap instead, combine the two, and it gets better results. All right, so what can we glean from that previous research is that there's not much consensus, to be honest, apart from the duration. You know, the longer it goes on, also the distribution. So duration means if it goes on a long time, you're unlikely to get, it's because it's not doing very well. Distribution, if you retain a lot or distribute less, then you're more likely to do well in the rounds. Okay, so we investigate these different hypotheses based on signaling, adverse selection, contagion, all the theories of the crowdfunding literature, using a couple of models, looking at the log of the amount raised. We take logs where, looking at scatter plots, we need to think that a log would be better for the linearization, because this is just a linear model. The target capitalization, the pre-sale, whether or not there was a pre-sale, the rating, if there is one, the size of the team. Most of these are raised in Ether, so we look at the F price, and we also look at the momentum of the F price, and various other controls and variables. And the similar variables are put into a logit model for looking at the probability that the amount raised exceeds something called a soft cap. So most of these have a hard cap and a soft cap. And if they don't exceed the soft cap, then they have to give the money back to the investors. So there's lots of data sources, ICO Bench, Crypto Rank are those we used. And if you're interested in this, Paul Montas uses, he makes his token offering research database free. You can just download it. It's a bit out of date now, but you can get that data from him. So looking at the determinants in this period, where most of the papers that we cited had data ending here, we find some very significant determinants in all of these, including whether or not the jurisdiction is in a tax haven. That seems to be a positive determinant of success as well. And the ones in red seem to change. So the amount distributed, that no longer is significant in the second 18 months, that's after the boom, nor is the rating. In fact, the ratings are really sort of disappearing now. There are sites such as blackdragon.io. Excuse me, I've got a bit of a frog in my throat. But the R squareds are not very large, but nevertheless, you know, dividing it in here, we do have a fair amount of data. We've got 600 in each of those samples. These are different, obviously. These are the ones that ended before June 2018. And these are the ones that ended in this period. And the full model here has got control variables such as, you know, did you have your KYC in process for the amount, for the money you're taking? All right, so, and similarly for the determinants of the probability of exceeding the soft cap, these are harder to discern. tax haven again was significant, but again, you know, in this period, very little apart from the target cap, which is obviously related to the probability of exceeding the soft cap. The lower the soft cap, the higher the probability of exceeding it, obviously. So, you know, we don't get very much from these, I think. Very low R squared. This is not the logit model. Excuse me. This is not the logit model. This is the ordinary least squares model with data from January 2021. Everything changes. We find that things like the distribution are still not important. Duration, the longer it goes on, the more profitable it is. We have a positive coefficient here. Target cap is still important, but the ether price and momentum also very important on all models. Things like social media, looking at number of Google searches for the token, not important, and so forth. R squareds can get up for the full model. We've got an R squared here of 0.579. We've also got many more actual offerings. They may have not raised so many, but there's 1,340 that go on straight onto a DEX, like Uniswap or Gate.io. There are lots of decentralized exchanges where you put it straight on there. You don't have to go through a ranking site like Crypto Compare used to be, and then try and get your token onto an exchange. It goes straight to an exchange. There are some that don't. These initial coin offerings don't. But you either go straight to something like the Binance Launchpad, or you go to a DEX. And in the full model, we don't just have the type, we have the categories. I haven't put the categories there. There's too many of them. And the platforms, the actual platforms, again, but I can show you the results of those. So these are the different platforms. Sorry, Gate is a centralized exchange. DAO Maker, Polkadot Starter, these are decentralized exchanges. So most of them went on to decentralized exchanges, and a few went on to things like the Binance Launch. If you get on the Binance Launchpad, you've got quite a big alpha there. So that's obviously, but there are only about, on a log scale, 7 that went on to Binance. Most of them went on to Gate if they were an IEO, and they didn't do as well as the average. So this shows that now it's the platform that really matters. We, you know, when we look at the R squared, adding in the platform really raised the R squared. Not so the type matters, but that's because it also has got the platform in it. But the platform is really important. When we look at the category, that seems to have less of an important influence on success, but we do find that the few that are in energy, as opposed to the loads that are in gaming or DeFi or blockchain, loads of them are in these categories. That's quite useful information. And also the few, special energy, verification, healthcare. If you're a really novel type of IDO, which not many people are considering, you do tend to raise more. Now I'm going to look very quickly at another paper with Michael, and this one is up on SSRN. It's hopefully going to come out in quantitative finance, like the other one we did, as a leader article. So almost 350-page papers have been published on volatility or risk models for crypto. This is the biggest area in total for crypto asset research. And so, you know, it's get some data, do a GARCH model. I remember when I first went into finance in 1987, I used to be an algebraist, and then I did game theory. And then we had the big crash of 1987. most of you weren't born then, I suppose. But there was a global stock market crash created by the introduction of options, really, and the huge leverage and gambling that Wall Street guerrillas were doing. And I was so cross about the effect that this had on emerging markets, places like Vietnam, Indonesia. You know, I was so cross that I decided that I was going to give up algebra and I would go and do research on risk management. Because if I could help banks to manage their risks, they would not do the same thing again. But I mean, I gave that up in the end, because risk managers have no power. They're not on the board. The Basel Committee just gives them tasks of measuring minutiae. Measure value at risk. No, measure expected shortfall. No, use this model, use that model. And most of them don't use GARCH models. I mean, it's pretty clear that the best is filtered historical simulation, and you might as well just filter it with an exponentially weighted moving average. That's fairly clear, and that's what most banks use. But nevertheless, academic research at that time exploded with GARCH. That was in the 80s, when Rob Engel had just introduced the first, and Boleslev, his student, Tim Boleslev, had generalized ARCH to GARCH. And I was lucky to be taught by these guys. So I got in very early I built the first GARCH models in banks in the UK before they had any software. And I guess that's how I got a bit of a name for myself right back then in risk management. And then I went into to try to help the industry with qualifications, professional risk manager and so forth. But that's all past. And I don't not do GARCH models, but I'm very skeptical, particularly in the crypto asset space, of all this research. Really, really am. So let's have a look at it. You know, you've got these papers, and we'll see where they're published later. There's this paper in 2016, one of the first looked at Bitcoin, did a load of GARCH models, did some in-sample diagnostic tests, some information criteria and so forth. And we go on and on, 2017, 2018, there's a load in 2018, even more in 2019, all doing Bitcoin and a few other currencies, all looking at GARCH and maybe Markov switching. Probably this is one of the better papers. David Ardia is quite good. He's got some nice code for Markov switching. GJR, for example, if you're interested in that, you can use his code. With different types of innovation distributions, etc., etc. Then there's these in 2019, and they go on and on. Same story, same story. We actually added a little bit to our data paper, so we're including it here. But the theme of this paper was not GARCH models. It was be careful about the data you use. For example, we started off with a capital asset pricing model and showed you got completely different results for a basic or single index model, depending on whether you used coin market cap or crypto compare or Coinco or whatever other data sources. They gave you complete. CoinGecko actually had an error in their data and they didn't even know. We wrote to them. Eventually they did correct it, but only after about a year or two after this paper came out. Anyway, so, and that's the other quantitative finance one. So what do we do with all this? Oh, more. Keep going on, more. Is there more? Oh no, right, okay. So what did we decide to do? We looked at all this and thought, well, you know what the industry is going to use? They're going to use a UMA. As simple as that. So we looked at UMAs and we also looked at GARCH. And a huge number of, we just looked at the four main ones, Bitcoin, Ether, Ripple and Litecoin. A lot of people look at those. And we did the sort of traffic lights diagnostics. Yeah, you can get more details in the paper. This is the conditional coverage for the clustering of exceedances. And we find that these UMAs are fine for all of them. The GARCH are usually okay. This is for 1% VAR. This is for 2.5% VAR. This is for the short positions, much more difficult actually. But still, you know, some UMAs are okay. GARCH can't manage the Ripple on a short. But the UMA's doing as well as the GARCH. if not better in some currencies, you know. What about expected shortfall? Well, again, you know, the benchmark is just a simple normal Garch. And then we've got the T Humas, and then we've got the T Garches, and we've got the asymmetric one here. Obviously, TE Garch is my favorite model when it comes to Garch, actually, for the univariate, that is. It's difficult to beat that one, sure, but you can do as well. Particularly on the short positions. And then we looked at hourly data as well, because these markets move so quickly that really risk metrics need to be done, not just at the daily level. And what do we find? We find that the Huma do even better, actually, than the Garch. Look here, you see. Short positions, they're much better. This is the ES. Okay, so just to conclude, so we've got time for some questions. I found this paper, it's here, Systematic Literature Review of Volatility and Risk Management on Cryptocurrency Investment. It's a nice paper. It does these networks of the authors and so forth, but it's pretty old. It stops in, I think it's March 2021, so it doesn't include half the papers that we were looking at in that literature review there. And I've just given one of their nice little network diagrams where they're showing the citations and the journals. And you can see, you know, the research and international business, lots of citations to financial research letters and applied economics letters. So for international review, these three journals have got a sort of, look at this, jump, jump, jump. There's a sort of nice little cycle of citations for each other. No wonder their rankings went to 9 for this one, because they were just citing each other. Because you don't have self-citations in the impact factor, but if you cite another journal, that's different, isn't it? Okay, that's the end of my talk.
Thank you very much for your very, very fascinating. I mean, the presentation actually, they have like, how can I say, like to have like very incentively evaluate like cryptocurrency research based on the data, based on the method, as well as like the plot, I would say the plot in the finance journal to create cryptocurrency paper. So now it's like the chance for ask questions. So anyone want to ask the questions for Professor Carol? Please. I recognize some. Yeah, please. Yeah.
Is anybody asking questions here? No, they're not asking a question. Compared to the traditional classical equity market, what do you think? What's the percentage, or how big do you think the noise traders, this speculative aspect is playing a role in this blockchain cryptocurrency market, especially NFTs, where you can actually, which is based on blockchain, and then there you can actually anonymously post the price to lure noise traders. And I'm just wondering, I'm not familiar with this market, so I was wondering what your take on the probability, the big part, what role the speculation noise traders are playing in this market.
I'm not sure what you mean by noise traders, but there are certainly a lot of manipulative trades going on.
I mean, manipulative is that what I was giving an example in NFTs, where you can post your own price, really high price, to manipulate the market so that giving a false signals to lure noise traders, what I mean. People who do not know the knowledge, but just following.
Okay, so let's just talk about NFTs, because it's, you know, if you talk about the other things, everything follows Bitcoin, which is just a speculative asset. To me, Bitcoin's useless, and it's the target of, if you look at my blog on the Bitcoin Tether Ponzi scheme, you will see exactly what's happening there. But on NFTs, the floor price is the last traded price, and it's very, very easy to manipulate. You can change the floor price. So these things are sold by auction, right? And the main marketplace, as I showed you, is OpenSea. It dominates most of them, but you can put it on how rare is or rareable and things like that. But and when you look on different sites, the same NFT on Coinbase also sells them, might be up for, you know, if you can buy now price as opposed to the auction price of 180 F. I just looked at one the other day. 180 on Coinbase and 103 buy now price on OpenSea. But anyway, most of them will follow something called a floor price, which you're right, is hugely easy to manipulate. And why? Because you can buy and sell it to wallets of your own, you know, so that's called the wash trading. Wash trading in NFTs is really prevalent. If you go to, did I just close all my Chrome? Wait a minute, I did. Oh, why is it doing that? Okay, let me just go to my slide on the Nansen link, so you can see what Nansen do for that. What they give you is a, here we are. This is the Nansen Analytics. Okay, well, let's go to, I think it's God mode. Yes, wash trading filter on or off, right? So if we look at, for example, the Bored Ape, too many Bored Ape. Let's look at the Yacht Club. That's by far the most commonly traded one. So this is with the wash trading filter off, and you can look at the volumes here. 160 were sold apparently, but if you put the wash trading filter on, then wait a minute, I was looking there, it's 180. They've changed their database, but anyway, okay, I didn't quite get that one right, because normally with the wash trading filter, the volume, that's the price, yeah, with the wash trading filter on. The volume is 34036, price 84. That's June this year. And with the wash trading filter off, yeah, volume is 5807. Okay, so there is quite a lot of wash trading that's going on in these markets where, yeah, they're trying to manipulate the price. So this is one of the problems that I'm actually working on at the moment, is how to tackle this manipulation of the floor price of NFTs. Watch this space, haven't sorted it out yet. Any other questions? Oh, there's something in chat. Let's have a look. Please stop sharing screen. Okay. Here we are.
Okay, thank you very much. Any questions in our group or in the Zoom chat? Please feel free to ask any questions. Actually, we just wait a little bit, maybe someone has questions. But actually, I just want to talk a little bit about the data that many researchers use for.
Could you just, can you move closer to the microphone? It's almost impossible to hear you.
Oh. Can you hear me better?
Yes, much better.
Okay, lovely. So I just want to wait. Okay, there's a question, so let me invite the girl lady first, okay?
Good afternoon. Thank you for your presentation. I'm Nguyễn. I'm from Swinburne University of Technology in Australia. I'm an economist. I have no background in finance or crypto currencies. I mean the Bitcoins, and it's quite interesting to know that the price manipulation in Bitcoin trade. I wonder how to identify the price manipulation, or is there any kinds of any ways to identify the intrinsic values of the Bitcoins and then identify the price manipulation? I hope for your comments and your advice. Thank you.
Okay, so there's another paper which you can find if you look at my website and you look under papers. I think it's probably the top one. Let me have a quick look. Yes, price discovery in Bitcoin, the role of limit orders. It's the top one on my papers page. So most price manipulation is done through mechanisms that are variants of what we call spoofing. Okay, so spoofing refers to the cancellation of limit orders. I would also recommend, before you look at that paper, because it's quite technical and it uses the whole limit order book, so there's quite a lot to absorb there, and the methodology is a machine learning variant. If you look at my blog, and it would be also on my website, go to blog, and it would be Binance spoofy bots cause mass liquidations. It's the second one down on my blog page, and that explains in more layman's terms how spoofing works with spoofy bots, algorithms that cancel limit orders. So I would suggest that you read those two for the full answer to your question.
Okay, thank you. I just follow up her question. So, you know, like the Bitcoin price can be manipulated. Now, I mean, in the past, people also talk about cryptocurrency, Bitcoin. So now today, many people also talk about like digital bank currencies. So they basically based on the platform related to cryptocurrency. So basically, if the cryptocurrency can be manipulated, so do you think that maybe central bank digital currency can be manipulated, and they have the problem for, let's say, for monetary system of one country, that China also try to implement central bank digital currency, just like our curiosity.
Well, CBDCs, as we call them, central bank digital currencies, will not be on public blockchains. They will not be traded on these centralized and decentralized exchanges at all. What is going to happen is that the Bank of England, for example, will build its own what we call private blockchain. There are different types of blockchains. They're all linked together. It's called a blockchain because it's linked cryptographically. But the consensus mechanism, proof of work, proof of stake, whatever it is, proof of history, that makes the blockchain immutable will not be there. So a public blockchain is very different to a private blockchain. A private blockchain is just like a ledger. You know, it's a digital ledger of all the transactions, and you need to therefore trust the accountant or trust the central controller that they are not going to be changing any of that ledger. So anyway, there's no way that a CBDC could run on a blockchain that was not a private one, but it will be a smart contract blockchain. Okay, so transactions are not just transferring money, but it will also be executing operations. And then you would need to have what we call oracles. So oracles will link that blockchain to other blockchains and data provision, you know, so there's a huge structure. It's a massive, massive problem. And, you know, I expect places like China to begin with a very rudimentary version because they have the biggest incentive because of the money laundering problem that they have. But other countries are much, much more bullish on CBDCs than they were a couple of years ago when a lot of them said, oh, no, we'll never do it. But it's a huge problem. It's a different type of money supply. Anyway, so yeah, it will come, but in a different form to the one that you said.
Okay, thanks a lot. Any questions? I thought that like there's one a college from US University, he published some paper about cryptocurrency, and maybe they have like any questions from this group? No? Any questions? And I just want to ask further on to the data, because I was fascinated with the paper that you wrote with that course of Davos about like less than 50% of the cryptocurrency paper use correct data from cryptocurrency data sources. I know that like in the past, many people only look at coin market cap as like very, very popular, I don't know, sorry, as very popular platform to grow the data, analyze the data, and some data. You know, do you have anything about like the follow-up study on the wrong use of the data for cryptocurrency? Do they have any problem? Can you tell a little bit about this paper? Less than 50% of cryptocurrency paper use correct data sets.
Well, I haven't been looking at it more recently. I mean, I wrote the paper back, it was published in 2020. So I think that the research happened in 2018 or 19. But in that paper, we showed that if you estimated a capital asset pricing model, you obtained completely different estimates of the beta on the broad market index, depending on the broad market index you use. But not just that, it's also, you know, depends very much on the single asset data that you use, whether it's for Bitcoin or Ether or anything like that, because the data providers will not give you, I mean, you can go straight to the exchange and just download using the exchange's API. You can just log into that and get a key to download the data. But a lot of these API keys are really clunky and they're all different and not easy to use. More recently, looking at the data providers, Kaiko have done very well, I think. Kaiko and Coinmetrics would be the two when it comes to sort of standard, not on the block data. I would recommend using those two sources. They're pretty reliable. But just remember that, you know, if you're looking at a trading strategy or something like that, as opposed to something to do with risk or portfolio allocation, you know, if you're going to allocate to a portfolio, you should use the right exchange price, like Coinbase, for example, if that's the exchange that you're going to be investing.
Okay, and thank you very much. And we have the last questions from online that you saw from Dr. Nguyễn from Lincoln University, New Zealand. So do you think algorithmic trading works for cryptocurrencies?
Well, that's what all the trading is. It's all robots. They're very, very fast markets, and there are many of them. So, you know, most market makers or professional traders will have robots operating on 4, 5, 6 different exchanges on the same products, and there's a lot of arbitrage goes on. That's very high frequency. So that's obviously done with an algorithm. Yeah, I mean, I know quite a few traders. Options traders will be using, you know, they'll be delta hedging with algorithms. The futures markets, and particularly those perpetual swaps, I mean, if you just log into any exchange, you can see the order book. You can see how fast it's moving. So you just go to Binance and put in the Binance Bitcoin Tether Perpetual. And particularly after 2 o'clock UK time, or when the US markets open, then, you know, it's incredibly fast and you can see every trade, and you can actually see the spoofing happening as well with the cancellation of trades in the order book. It's certainly worth doing. I could very quickly show you, if you don't mind me sharing my screen.
Please.
I'll just have a look at so here's the order book on Binance Tether. That's the one of the biggest crosses. So you can see it's not as fast now as it can be when there's a lot of volatility in the market. It's very quiet time, and it's not after 2 p.m. UK time. So it all hots up after that. But if you look at the order book, let me see if I can blow it up. Yeah, so you see the order book and the actual trades. So you've got quantities like 13.9 and that. Okay, there was quite a big trade there, 13.35. Let me see whether I can see any spoofing going on. You can also see wash trading on some of these exchanges, less so now. But, you know, it's all in milliseconds. If you look at the timestamps, okay, so, you know, the last minute, well, you know, you have like 3 or 4 trades per second just on Binance. And it goes much, much faster at other times. There's probably more trading on the ETH perpetual, to be honest, because of the merge. So, I mean, I won't look at that right now, but yeah, algorithms are definitely at play here.
Okay, all right. So thank you very much. I think that we run out of like 1 hour for presentation and also discussion. So we benefit a lot from your talk related to critical review about like the crypto creatures, about the data, about the risk model, and also some agents maybe for those who are interested in doing research in cryptocurrency. So on behalf of ACBES 2022, we would like to say thank you very much for joining us today. I know that like it's a little bit early morning in Sussex now, in Bristol, I mean, right, in Bristol now, and wish you have a nice day. And we hope to have you in person one day in Vietnam and also in UES University. Thank you very much.
Bye. Thank you. Bye.